Gold is approaching a major liquidity zone right now, and smart money is actively preparing the next massive move. We're skipping the background fluff in today's explainer. My primary focus is a potential sell setup above key liquidity. But, well, there's one specific condition that has to happen first. Let's get straight into the institutional blueprint for XAUUSD.
Right now, most retail traders are looking at entirely the wrong levels. They're blindly trying to pick a bottom based on outdated support and resistance concepts. But here's the reality. Institutions are actually targeting the 4027.20 sell-side liquidity area. Let me show you exactly why they're positioning themselves for this specific drop.
I want to give you the outcome before the explanation. So, before we break down the why, here's the exact trading plan. Our daily bias remains heavily bearish. The primary sell zone we're monitoring sits right around that 4060 to 4066 level. This aligns with an hourly fair value gap and a breaker block, basically an area of heavy institutional pricing imbalance. Now, to execute, we require a 15-minute market structure shift for confirmation, targeting that liquidity near 4027.20. You now know the entire potential trade.
But here's the problem. Why are institutions drawn to this exact liquidity pool today? What makes 4027.20 such a high probability target for smart money, while the rest of the market just gets chopped up in the noise? To actually understand institutional intent, you have to look past standard retail indicators.
When you compare the H4 macro structure with the H1 dealing range, the narrative becomes crystal clear. Notice the aggressive bearish displacement we just saw rejecting the 4117 highs? Smart money is actively expanding downward. They've already engineered a major sell-side liquidity grab on the daily time frame to trap early buyers. And right now, they're systematically sweeping internal liquidity on the lower time frames. They're basically building a massive payload of orders before launching the next heavy leg down.
And this is where a vulnerable liquidity pool changes everything. Take the relative equal lows resting at 4041 and 4027.20. They are highly exposed. Why? Because we've seen severe, aggressive downward displacement away from recent highs, with zero significant bullish momentum to offset it. There is clean sell-side liquidity sitting directly below these levels, literally a massive cluster of retail stop-loss orders. That makes them an absolute magnet for institutional pricing algorithms.
Now, what's really interesting here is exactly where the institutional premium pricing resides. We've got an unmitigated H4 bearish order block and an open fair value gap resting just above current price action, precisely between 4882 and 4098. The footprint of bearish institutional order flow is firmly in control. But listen, the algorithms rarely just drop in a straight line, right? To access that premium pricing and build enough volume for a massive short, they need a catalyst to temporarily drive price upward.
And the market is sending a warning signal about that right now. Today's U.S. New York session data, specifically the ADP employment change and CB consumer confidence reports, that data is going to act as our liquidity catalyst. Institutions consistently use this kind of scheduled, high-impact news volatility to engineer a Judas swing. It's a false price run designed to trap early retail positions. We expect price to be artificially pushed up into our premium fair value gap just to clear those positions, right before the true order flow resumes to sweep our sell-side liquidity below.
So, let's talk execution. Here's our executable scenario 1 for a short position. First, wait patiently for price to trade up into our 4060 to 4066 entry zone. Second, demand a clear 15-minute bearish market structure shift with downward displacement. Actually, I can't stress this enough. This is non-negotiable. If it doesn't print, we don't trade. Third, place your stop loss safely at 4075.50, just above the structural swing high. Finally, take partial profits at 4041 and hold that final target for 4027.20. This gives us a highly asymmetrical risk-to-reward ratio.
Looking at our current market status, there is absolutely no actionable trade right now. Why? Because that required 15-minute smart money confirmation hasn't appeared yet. As professionals, we do not front-run the algorithmic footprint. Our execution confidence sits at 0 until that confirmation prints. But the moment we see that liquidity sweep and structural shift, it jumps to 85%. Remember, patience is what separates institutional methodology from retail gambling.
Which leads us to a really critical question. Where will most retail traders get trapped today? There's a specific scenario playing out that most traders are completely ignoring, and understanding it is absolutely vital to protecting your capital.
Right now, retail traders are selling way too early on minor time frame dips, or blindly buying at discount support, praying for a macro reversal. Smart money is doing the exact opposite. They're waiting for a premium fair value gap rebalance and a sweep of the Asian session highs. This is where smart money sets the trap. Those early shorts, they're going to get stopped out during a violent upward liquidity sweep, becoming the exact counterparty liquidity institutions need to fuel the real drop.
But what if the market narrative shifts? As a professional, you always need to know exactly where your idea is wrong. So this level becomes critical, 4088.50. This is our hard invalidation level. If we see a sustained 1-hour body close above that, it completely destroys the immediate intraday bearish order flow. It tells us institutions are seeking much higher macro liquidity first, and we cancel the short setup immediately. We never hold and hope, we adapt.
Let's rapidly recap these parameters so you have the institutional blueprint firmly locked in. Daily bias is heavily bearish. The premium entry zone we're hunting is 4060 to 4066. Strict invalidation is set at 4088.50. And the primary draw on liquidity, our ultimate target, is 4027.20. And as always, keep your risk strictly to a maximum of 0.5% to 1% per trade.
And that completes today's explainer on the XAUUSD institutional order flow. If you enjoy calm, precise, institutional-style market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM trading account link in the pinned comment below. Stay patient, wait for your sweep, and execute with precision. But I'll leave you with this to ask yourself as you watch the charts today. When the scheduled volatility spikes, will you be the one hunting liquidity, or will you be the liquidity they're hunting?